Hello, and a warm welcome to everyone tuning in. I am Jun Yuan, founder of the Singaporean Investor, and I'm excited to have a very special guest with us today. He is Singapore's very own REIT specialist, Kenny Low. I first came across Kenny's insightful contributions on investing platform Investing Note, where he was posting under the handle Marubozu when I first joined the community back in 2018. Our first in-person meeting was earlier this year at the REIT Symposium, where I had the honor of sharing the stage with him to discuss about FIRE. While sharing my thoughts with fellow attendees at the really awesome annual event, I have also benefited a lot from Kenny's insights during the session. Since then, we have connected at the various events, and each time I have learned a great deal from his extensive experience in REIT investing. And for that, I am truly grateful for his generosity in sharing his knowledge. Today, it is a privilege for me to have him join us on my YouTube channel to talk about the latest business updates and financial results from the REITs for the third quarter ended 30th September, along with some of the key issues impacting the REIT industry. Before we dive into today's discussion, Kenny, could you give our viewers a brief introduction about yourself?
Hi, Julian. Thank you for inviting me. All right. Hi, everyone. I am Kenny Law. I'm a REIT investor like all of you. I started REIT investing since 2009. It has been a very long way, about 15 years already. I am currently the Wealth Advisory Director for my independent financial advisory firm. So basically, when I first started off, I am just writing a blog like Julian just started, right? After writing a blog for a few years, someone asked me to train them in terms of all the REIT courses. And recently, I actually did a mid-career career switch and to become a financial advisor, because during the last time when I was a REIT investor itself, I'm not able to advise the client what to buy, what to sell, because under Singapore Financial Advisor Act, no one's supposed to really, without license, no one can give any recommendation in the public. So my student asked me, why don't I go and get a license so that I can help them to really manage their investment portfolio, also advise their investment portfolio. This is where I take the opportunity and to make mid-career switch to become a financial advisor. So this where I am now. So besides REIT, actually, I can advise a lot more investment instrument or also solution. All right.
Yeah, so I will maybe you can share with the viewers the link to contact you. So for those of you who want to seek financial advice, yeah, he's the best person to seek financial advisors from.
Yeah. Maybe at the end of the session, I will share where to contact me.
Yeah,
All right, the link.
sure. Yeah. Okay, maybe can I start off with the discussion by talking about the REIT's latest third quarter business updates or quarterly results. So have these results surpassed your expectations, or have they met or fallen below what you have anticipated?
Actually, this is what I anticipated. I don't expect for the next 2 or 3 quarter the result will be good. So I'm actually expecting for the latest earning result, for example, the most recent earning release, and also another 1 or 2 more quarter, we should expect the REIT will report drop in a dividend yield, right? Definitely there'll be drop because the interest impact they will start to creep in. Although we already seeing that the interest rate start to coming down, but this interest rate impact will not shown in the P&L statement for the REIT itself, and also the valuation will continue to come down in the next 1 or 2 quarters. So for the investor, we just need to take note that although the macro environment and also interest rate direction is favorable moving forward for the REIT sector itself, but we should also expect that to see the drop in dividend. That actually drop in dividend will create a lot of fear to the investor itself, right? So we will not see any strong recovery in the REIT sector until the next 2 or 3 quarters when the full impact to be felt on interest rate cut.
So you are actually looking at 2025 for the interest for the dividends to recover, or are you looking at 2026?
2025, mid-2025. The reason being is because although the interest rate cut, they will not have the REIT may not have enjoy the immediate rate cut because some of the debt they are still having a very high fixed rate percentage. At the same time, they don't have any immediate term or debt to be refinanced. Because if you don't have any debt to refinance at a low interest rate, basically there's no impact on the DPU itself. And during the past 2 or 3 years, most of the REIT, in order to really fix their debt profile, actually they refinance to a later date. Some of the REIT that actually they refinance, the debt maturity profile is beyond 2025, even 2026. So whenever there's a cut in interest rate, you will not see the immediate impact when they have a lower interest expense and at the same time also increase your DPU.
So in a way, those with a higher percentage of borrowings due for refinancing in 2024-25 will probably see the impact of lower interest rates and beneficial to the DPU faster than those without.
Yeah. So investor really want to look for immediate recovery in the REIT DPU itself. Look for those REIT with a very short debt maturity. That's one thing. And the other thing is they have a high percentage of floating rate, right?
So now
But
it's
if
the
they
opposite way.
yeah, now that's why you can see that actually the selection criteria is opposite. Half a year ago, the selection criteria is all of us want the debt maturity profile as far as possible, so that they don't have any risk of refinance. Because if they have any risk of refinancing, they may have to sell the property because of the gearing ratio you're coming up, or also need to refinance at a higher rate. And during that time, half a year ago, we also want to see that actually the REIT itself has a very high percentage of fixed rate. Now it's
Yeah.
totally changed the criteria. So one of the key things to take note for the retail investor is when we analyze the REIT itself, we have to base on the current situation and change our criteria accordingly. There's no one size fit all criteria. Today you learn that this kind of financial ratio are important. Maybe the next day when the macro environment change, your financial ratio requirement will change.
Yeah, completely agree with you. Because prior to the increasing interest rate environment, I wasn't looking at the percentage of borrowings hedged to fixed rates until
Mm.
the interest rates rose to like a 20 over year high. Then I started to think that, hey, I think it's time to look at the percentage of borrowings hedged to fixed rates.
Yeah,
So,
yeah,
so
yeah.
now it's a
But
different case.
that's why I have 15 years already. Actually, every few years, the criteria change.
Yeah. So as investors, it's important to actually be adaptable to the situations lah, and then
Mm.
to have different strategies accordingly. Yeah. So moving on. So considering the current global economic climate, what significant challenges and opportunities do you foresee for the REIT industry over the next 3 to 5 years?
Okay, so the challenge for the REIT itself or in a real estate sector as a whole basically is the interest rate. Okay, there's no rocket science. Because investing in real estate is a highly leveraged kind of business and also sector. You can run away from interest rate. So as long as the interest rate remain high, now there is a fear of after Trump elected to be a president, there's a fear of the inflation coming back, right? That's why you can see that there's a big correction in the REIT sector itself. And also you can see that there's a spike in the US 10-year risk-free rate to 4.4% as of yesterday. This is very high. So the US 10-year risk-free rate basically indicate the potential inflation coming into the picture itself. When the inflation is in the picture, the Federal Reserve, they may hold back the interest cut, all right? Then also maybe there's a fear that they may increase the interest rate. And all these interest rate movement, if they stay high or increase moving forward, that will have a very detrimental effect on the Singapore REIT sector and also real estate sector as a whole. Okay, but those are the speculation at the present moment, because at the end of the day, we need to look at the actual number, the GDP number, the employment rate, and also inflation rate before we can really conclude. So at the present moment, basically the market is reacting to the sentiment. It's more on sentiment driven, right? May not be necessary the fundamental of the economic has changed. So for those investor, if you're seeing a big red color in your portfolio, you sit tight, because it may not true, the inflation may come back. We just need to wait for a while to see how the movement, the 10-year risk rate moving on, right? But on another hand, that if the actually inflation really continue to comes down, and also the US 10-year risk rate is continue to come down, that's represent the opportunity for the Singapore REIT, because at the current during the recent correction, actually as REIT sector getting close to the pre-COVID level, during COVID crash level, in terms of the FTSE ST REIT index level, and also the price to book level. It is getting close to that level. That actually represent another opportunity for investor to really acquire or accumulate REIT at a good discount, right? Then if the interest rate really continue to comes down, that will help in the lower down the interest expense for the REIT manager. When the interest expense is lower, definitely the DPU will grow up over the long term, but it's not immediate. That's why investors need to be patient to wait for the DPU to grow and also return. At the same time, the valuer probably will start to revise the cap rate, maybe to the lower cap rate, right? That will also help in the portfolio valuation. When there's a portfolio valuation being adjusted upward, that will help in the net asset value. And there is always a ratio between the price to book or price to net asset value in the stock market itself, in the REIT market itself, for us to do a reference to assess whether the REIT is undervalued or overvalued. So if the net asset value goes up, basically the share price will goes up also. All right. So the third factor would be when the interest rate will come down and everything to be normalized, it is expected the 10-year risk-free rate will be coming down eventually. When the 10-year risk rate comes down eventually, the big institution fund, they may move back to this sector, because you just need to think of fund manager. What are the big institutions are doing? The big institution is always looking for opportunity to optimize the return of the portfolio for their client, right? So if the risk-free rate coming down maybe to 2 to 3% level, but the REIT sector giving you 5 to 6% level, the yield spread is maybe quite attractive for them to really do the rotation back to the dividend stock level. So all the dividend stocks like REITs, like the some of the bank stock which give a very high dividend itself, they may rotate back in the life in enter into bull market. So basically the interest rate is the main driver at the present moment to determine what will be the future direction for the REIT sector.
That's a very, very detailed insight, Kenny. Really appreciate it. So one of the things that REITs grow is through acquisitions. So how do you think, as far as acquisition goes, how will the REIT manager go about doing acquisitions in the next couple of years, since interest rates are coming down? Do you foresee more acquisition activities coming up?
Yes, definitely. You can to see that actually some of the REITs start to announce the acquisition plan, and some of the REIT, although they have not announced in the public yet, but through the conversation with the REIT CEO, because you and me, we know that sometimes we have an opportunity to talk to some of the REIT CEO, they already mentioned to me that they are looking into it, right? Another reason is I think that this 1 or 2 year would be the sweet spot for M&A. The reason being is because during the property valuation, probably he has already find a bottom, because the property valuation is very much depends on the cap rate and also your discounted cash flow for the future rental income. Assuming the economy continue to do well, being strong, your rental income and also all the discounted value to the current value will not be impacted too much, right? But your cap rate, reduction in cap rate, will help in the portfolio valuation. Right. So in short, moving forward, the portfolio valuation will goes up, right? But if you want to buy the property, you want to buy property at a low.
Correct.
So this is a buyer market for them to acquire the property at the low valuation, right? That is the opportunity. That's one. And second thing is for the lender. They want to lend the interest rate as high as possible, because moving forward, if they don't lend now, then they lend in one year later, the interest rate will be lower. So the lender is more willing to lend. That's why you can see that why there's sweet spot. The valuation more or less is bottom. If you acquire now, you really can buy a bottom, okay, close to bottom. On the other hand, you are able to get a funding from a lender. At the same time, this is the buyer market, right? So the buyer market, the buyers start to come out to look for good deal. At the same time, whoever seller, they want to sell the property for the past 2 or 3 years, they can dong until now. It means that they still want to sell. I think that they're willing to let go, right? So you can look at the dynamic buyer, seller, and also the lender. I think that this really provide a sweet spot during this 1 or 2 years. Okay, so I expect to see the acquisition activity goes up, which has already happened. We have seen a few announcements from the REIT manager itself. I can foresee that more activity or announcement to be made moving forward.
Oh, that's very good because having acquisitions is one of the ways that the REIT can improve on its financial results as well as DPU to unit holders. I'm certainly looking forward to that.
Yep. On the other hand, okay, all the retail investors be prepared to fork out more money for the right issue.
Yeah, I think that is something that we have to be like mentally prepared for it to
Yep.
happen.
Yep.
So moving on, one of the biggest things that people have is the impact of hybrid work arrangements on office properties. So what's your view on these trends affecting office properties held by the Singapore listed REITs?
Okay, so one of thing that investors should not lump everything together because the office in Singapore is very, very different from the office in Europe and also in US, right? So I just go through regional by regional. For Singapore itself, I don't think will be many affected because due to limited of supply, that's first reason. And also that Singapore being the regional financial hub, there will be a lot of activity coming up. For example, all of us that we have been hearing, the family office is coming here, the fund from China, from other country are actually flowing into Singapore itself. And you need a lot more office space to really for that kind of family office, right? That's one. And at the same time, when the family office, all the wealth management really coming to Singapore itself, definitely you also bring the activity for all the whole ecosystem, because you can see that actually Singapore is also is a fintech hub. At the same time, now we are moving into crypto and also artificial intelligence. All right, there are a lot of new technology, new ideas, new financial initiative already coming in Singapore. All right, and due to limited supply itself, uh, uh, the office rental definitely can be hold well. For the past few years, even through the very negative turn period for the commercial office itself, you can see that actually Singapore office valuation is holding well. And instead, they also have a positive rental reversion compared to other region. So Singapore office, I would say that it can be quite stable and also sustainable moving forward. And also probably the rental reversion continue to do well, the rental will continue to go up or at least hold at the current level. When you come to overseas, definitely they are not so obedient as a Singaporean like us. When a boss forces us to go back to office 5 days, we have to go back. All right. So for those other country, I think that eventually the employee will go back to the office eventually, but you take some time. And if the economy not continue not to do well in those regions itself, that will speed up the return to office. The reason being is if those employee in other regions, for example, Europe or US, if the employee can really work from home, they don't need to go to office. They also may face the danger that one day their job will be replaced by somebody overseas. Because if you don't need to go back office, the job can be replaced easily by the low cost region. So that's one of the things that employee in those country they may not realize now, but eventually they'll be realized because with the artificial intelligence, there are a lot of routine job, a lot of admin job. Actually, you can replace by the machine. You can replace by the AI, right? So so that I think that eventually they'll back to office. And at the same time, if you have chance to really visit those big city in US, UK, or London or Amsterdam, you can see that in the city area, they are very, very crowded. no way you can demolish the office building and rebuild. It's very, very difficult. So in the highly dense city with a huge population itself, is the demand of an office definitely is there, right? So as long as you have a people living in the nearby, and also they need the officers for the activity out, eventually the office will find their way to really suit the needs. Okay, this is exactly same as a few years ago when the e-commerce come into the picture itself. You know that REIT investor, what they do? Okay, given all the reporters say, okay, there's an end of the world of retail mall, right? Let's sell all the REIT. Okay, REIT, you die and those things. Just go and take back, Google back all the all the story. But how the retail mall evolved now, they become the mega so-called food court now. So more Singapore. At the same time, also the childcare center, right? Actually, they're evolving. So I would say that definitely there are challenges in the office space, but they will evolve because they are the expert in the industry. As long as you are in the good location, you have a good property, as long as there's a people, there's a traffic there, they will find a way to really redefine the use of the office space to really to uh and can continue. That's why I don't think that work from home, that kind of phenomena, will be the end of the world for the commercial office. I totally don't believe. It's only then during this period there will be some challenges, but the REIT manager, they'll find a way to really figure a way up to really find a new solution.
Definitely, I completely agree with you. I think change is the only consistent in this world. So it's either you shape up or you get shipped out.
Yeah, yeah. And also do take note, another thing is REIT manager, they have another weapon, all right? If they are not able to really revive a property, they can sell it away and go and acquire another new one,
Yes.
right? So there's not really end of the world for the office REIT manager. They still have those tools to really reconstitute their portfolio. Currently, some of the US commercial REIT, office REIT, they are actually reconstituting their portfolio. We are seeing that some of the REIT manager also reconstituting their portfolio itself, right? Even the hospitality trust we attended last week, the meeting, they are reconstituting their portfolio to make sure their dividend income is more resilient moving forward.
Yes, I think that's very important and also very assuring for investors that the REIT managers are actually finding ways to see how they can evolve and move based on the trends.
Yeah, yeah. That's why that will lead to another thing, right? When we evaluate the REIT manager strength and also core competency is very, very important. Whether they have a knowledge to do it, whether they have a strong sponsor behind to support them to all this kind of portfolio reconstruction, and also the financial arm, the sponsor experience are very, very important. So for investor really looking for the REIT for the long-term investing itself, these are the things that non-financial KPI, non-financial ratio. This one is more on the qualitative kind of analysis, and it's very, very important. But unfortunately, not many people have a privilege like us, we can access all this information by talking to the REIT management.
Yes, I agree with you, especially those who are new and it's hard to find all these information through annual reports and all that. So on that regard, what advice would you give to new investors who are looking to invest in REITs?
Okay, first thing first, will be very, very different from what other people pitch. All right, this one are also is learning through the hard way, right? Because I'm also a REIT investor myself, now become financial advisor. Okay, make a lot of mistake, and also finally I realized one thing. Okay, the most important thing, focus on objective. Objective is the most important thing, right? So if we are investing in REIT, the purpose of investing in REIT is just for dividend, right? Whatever volatility in the market does not matter to us, right? Because investing in REIT is like investing in real estate. When we want to invest in real estate, what are the most important criteria when investing in real estate? To the common sense, no financial ratio, all right? No debt maturity profile, no lease expiry, ICR, no. Okay? Real estate investing, basically, we want to buy a property at a discount in the good location, and also able to generate consistent rental income, right? And we are just being the mini landlord, just collecting rental. But want to collect rental, we need to have a long-term view. It's not today I buy a property, the tenant come in, you collect 1 month rental, then after that you sell your property. No, right? We are holding for a long term. So that is very, very important. But if you look at current way of the investor, when the share price drop a little bit, and also buying the real estate, physical real estate, you don't look at the property price every day, right? If the property price drop by 10%, 20%, so what? It's not important anymore because my objective is to wait for the tenant to pay me rental, right? So investing in REIT, once the investor know clearly that is the objective, I'm just buying the REIT at a huge discount and give me the long-term rental or dividend income, I am good enough with it. Because if you look at those some of the very, very regular or veteran REIT investor, okay? For example, David Koh, Christopher from Dr. Well. If you have a chance to talk to them, basically they just buy and hold and collect dividend, right? They don't sell. Market crash does not matter. It's not important at all. They continue to accumulate, right? Accumulate and continue to generate the income. They only sell when the fundamental of the REIT has changed, right? And also that's why the objective is the most important thing, because we can only control our objective, right? Then beside our objective, the rest of the thing we totally is out of our control. For example, many a time we select the best REIT to invest in Singapore, the best fundamental. You have done many weeks of research to find that, talk to the REIT management itself, right? And you subscribe to a lot of data to find that this is the best REIT in Singapore. After that, you invest into a lot of it, but they still go through a 20% or 30% correction, right? Is this something wrong with our methodology? And also the way we do research is nothing wrong, right? We did nothing wrong, right? Because there are two more factors that are totally out of control, no matter how much work we have done. One is the macro environment, right? Even though we know that interest rate is coming down, that is positive to REIT. That's why you look at all the analyst report, everybody overweight, everyone overweight the S-REIT sector. But for the past 1 or 2 months, what happened to the REIT sector? Plunge, right? And why plunge? Trump. Trump caused the 10-year risk-free rate to goes up. Those things we cannot control, right? So is that something wrong with our analysis? Nothing wrong with our analysis. And is there something wrong that the fundamental of the REIT itself? Because if you're investing in Singapore REIT itself, they are still collecting a rental. We are still visiting the mall, right? Nothing wrong, nothing changed, right? So the macro environment, you make the stock price very volatile, right? If that kind of thing happen, we don't really need to bother, because those are sentiment driven. Okay, that is one factor we cannot control, but actually our portfolio still lose money. All right. Another factor would be the fund flow. Okay, we can say that, okay, interest rates coming down, okay, there's no inflation coming in. As long as the big institutional or those big fund manager, they don't move their money into this REIT sector, the whole REIT sector itself is still muted. You cannot go up, because only the big institutional fund can move the share price. For retail investor, we cannot move the share price. Okay, now come to another thing on the REIT selection itself. Okay, investing in REIT, big cap REIT, the Temasek link REIT is safe. Definitely will not lose money. All right, the share price will not climb too much. Okay, wrong. I can tell you also wrong. Right? The reason being is because those big cap REIT, they normally have heavily weighted in the index. Right? When you are traded in the index itself, is accessible to those big fund manager. Big fund manager can come in today and also can get up tomorrow, because they are trading the REIT sector. So those big cap REIT with the fund manager moving in and out actually have a much more higher price volatility, right? Compared to those small cap. Small cap, basically they cannot enter, right? They can, because that's too small for them. Right? At the same time that the fund manager don't have any allocation. So when there's a very big correction itself, actually fund manager is not in the picture. So you can see that there are so many moving elements and also things we cannot control. So the only my advice is focus on what you can control, which is to build our dividend portfolio to achieve our retirement, or to buy a property, to buy a house, or for children education. Once we are able to meet our objective, they are able to generate a consistent dividend for us, I think it's good enough.
Yeah, very interesting share, especially the part on where you said that even for Temasek Link companies, it's also not so-called a sure win, that kind of thing. And really appreciate that. But of course, being investments, there's nothing called a sure win. So definitely there will be one or two that will be like not so good. So when it comes to evaluating these REITs, what are some of the things that you look out for to deem that a particular REIT is considered as a red flag and you should divest? Because I think this is something that most people don't know.
Also depends on what kind of market condition, right? Let's say before COVID, debt management is not a major thing at all, right? Before COVID, I believe that you started quite early, started before COVID. You know that we don't even bother to look at the ICR and floating rate. We don't bother. I also don't bother, right? So during that time, what most of the REIT manager do is they are going for aggressive acquisition. Right. One thing we just need to make sure that when they go for acquisition, there's no conflict of interest. For example, because they also can make some money from the acquisition, because they always charge certain percentage when there's a successful deal, buy and selling. All right. So we just need to make sure that whatever thing they do has to be yield accretive or NAV accretive. The NAV has to increase year over year over the long term, and also DPO has to increase year over year over the long term, because that one can see clearly. And some are read that even under the low interest rate environment, their NAV is dropping, and also the DPO is dropping. Those are the red flag. Because when everything is so rosy, their performance is still so bad. I mean, they did something wrong, or they are doing something is not favorable to the investor. So the management decision and also some of the governance are important, right? During the low interest environment, because they are aggressively going for M&A. Now, during the high interest environment and during COVID, actually the capital management are the most important thing, right? Because we worry the REIT, if they are not able to do some refinancing, they will get into trouble because the creditor will come in. Okay, I know that last time you wrote one of the REIT, China logistic REIT, you go into trouble. Actually, I detected that issue after I saw their debt maturity profile actually less than 1 year. Okay, and also all their property are secure. Those are red flag. Okay, the reason being is because if they are not able to refinance within 1 year, and during that time, actually, the China property market is pretty bad also. If they're not able to refinance, they go bankrupt. And this is what happened now, right? The REIT is suspended, and they are also going through a liquidation. Okay, this is what happened. Actually, I did advise my client actually to get up during that time, and I'm fortunate, able to get out at 70 cents, which is quite high.
Yeah, it's one of the highest that
One
the
of the
REIT has
highest
reached.
price during time. So the financial ratio, that's why the investor really need to look into a deeper financial ratio, really need to understand the business model, because the business model is very, very important. We don't look at the financial ratio on the surface. We need to interpret and also understand what is behind the financial ratio. So those are the thing that the report I'm looking at.
Oh, I see. I see. Thank you so much for the sharing. So I understand that you have developed a research tool called REITsavvy Screener that helps investors to quickly grasp the essentials of a particular REIT. Could you share with us how you make use of this tool yourself to help you make your investment decisions in REITs? Because you've talked about quite a number of statistics that the investors can look at, which I think it's very troublesome for and also very time consuming for investors to really browse through the presentation slides for many, many quarters, and it's very time consuming as well. So perhaps you'd like to share with us how you use this tool to really speed up your research and
Yeah,
make your investment decisions.
definitely. Julian, let me share my screen.
Yeah.
Right. I think I briefly went through this one with you last time. Now I can go in more detail.
Yeah, it's a very good tool, and I think it will really help investors speed up their research on REITs.
Yeah, that was my purpose, because when I first started teaching REIT, it's a nightmare to do research. Really, it's a nightmare because you have to go through all the financial report and also the business update to extract all the information. Especially when it comes to do comparison, it's very, very difficult to do comparison. And when we're doing a research, we only have those information at that point of time. It's a snapshot. We are not able to track what was the past performance, because when we want to compare the REIT, whether they are doing better or doing worse, we need to compare to past results. So the past performance and also past results are very, very important. So that's the reason I decided to build a REIT screener. Originally, it's for myself to speed up my whole research, because I just use less than 5 minutes. I can more or less that decide whether this REIT can be invested or cannot be invested. Right?
Wow.
I know your pain. I know your pain. Okay, so this is the one snapshot of showing the 38 REITs in Singapore. It's not 41. The reason being is there are differences between the REIT and also business trust. I remove all those business trusts and property trusts in my screener. Right? This is different from SGX definition, right? SGX include the business trust and also property trust in their calculation. But for me, I just purely focus on REIT. All right. So also basically there are 38 REIT over here. And as and when every quarter when they have updated the quarterly update and also or the business update, okay, my team will update all the data here. Right, we try to aim to update data within 3 days after the earnings release. And also there's an industry here. I classify the industry purely based on the SGX classification. Try to be consistent with SGX as much as possible. And I also track the daily price. This is not the live price, it's the end of the day price. And also track the daily, weekly, monthly, and year-to-date performance. Okay, why I track this one? Because from the performance here, I can see that whether this REIT whether is in rotation, right? Let's say that, okay. For example, you can see that we know, all of us know that US commercial or office REIT, they are out of favor. And you can see that actually all negative here. But one day when it start to turn, right, the short-term performer, you start to turn green first, right? Daily, weekly, money start to turn green. We know that there's a potential, actually there's a reversal. So I'm use the price data to determine when it's a reversal, right? For at the present moment, definitely not reversal, because they are still performing quite badly, right? If every month, if I want to understand that actually which REIT have an interest of a big institution, the money coming in, right? And which sector, from here I can see it, right? Weekly performance, monthly performance, I can see it. Now is we can see very clearly that actually nobody is interested in REIT. Okay. Okay, basically you don't see positive here, or all negative, right? Okay, most of them negative. And okay, when I want to select those REIT which have a very big market cap, I just click the market cap over here. Then I just focus on those REIT with a very big market cap. Then from here I can do my selection already, right? If you want to avoid all the REIT with a very small market cap, just click on small market cap and just avoid. Right? Because when the REIT have a very small market cap, basically they don't have a big sponsor behind, right? If anything happened to the REIT itself, basically no one can rescue them. Okay. And this is a trailing 12-month yield. And from here, immediately I can see that these are the REIT do not pay dividend. Okay, Keppel Pacific, Oak REIT, Lipo Mall, Manulife, BHG, okay, Prime, okay, they have a limited dividend. This yield spread, basically, it just give me some indication, right? Another valuation criteria to see that whether the yield given by the REIT itself compared to the 10-year Singapore risk-free rate. Okay, I standardize to all 10 years, okay, for easy reference, because otherwise it's very difficult to manage, because some of them you'll be a US risk-free rate, some are Singapore risk-free rate. So I just standardize everything based on the yield of the REIT itself minus of the Singapore 10-year risk-free rate. Okay, gearing, from here I can see that one shot, I can know that which REIT has the lowest gearing, which REIT has a higher gearing. Okay, so these are just pure number. What we need to do is we need to combine the number with some of the other financial ratio. For example, if you want to focus on capital management, those REIT with very high gearing, all right, coupled with high interest cost and low interest cover, that will be a very dangerous REIT. Okay, the reason being is, first thing, they have to meet the 50% regulatory requirement. At the same time, they may not be able to refinance a debt. The reason being is because the bank or creditor, they are not stupid. They see that actually the REIT has very high gearing, there is a very high risk of defaulting. And they are refinancing at such a high interest cost, and also interest cover ratio is less than 2.5%, 2.5 times, or even lower. They also worry the REIT may not be able to do the refinance and pay for all the interest or coupon. Okay, so that will really give us some indication which REIT are in trouble, right? But on another hand, if you want to see that which REIT has a very healthy capital management, for example, Fraser Logistics and Commercial Trust, gearing 33% and the interest cost 2.8%, right? You just look at it, although they are borrowing, but they are able to generate the TTM yield of 6.7%. That is a very healthy yield spread here, right? And the interest coverage ratio 5, which is pretty good. Okay, and also their fixed interest percentage is pretty high, 73%. Okay, from here I'm also able to really identify which REIT has the lowest interest cost. For example, in this case, the Daiwa House Logistic Trust, the interest cost all in is only 1.1%. Okay, followed by the Parkway Life 1.4%, REIT Global 1.9%. And of course, once we know all the data, we need to deep dive into it to really understand why they are able to have such a low interest cost compared to others. Because even a Temasek Link REIT, for example, Mapletree Industrial Trust, their interest cost is 3.2%. Keppel DC 3.3%. And they are very big, they have a very big sponsor, but why are they not able to get a very low interest cost, okay, compared to Daiwa House, Parkway Life, and REIT Global? Okay, the reason being is because Daiwa House borrow in Japanese yen. Parkway Life also borrow majority in Japanese yen, because Japanese yen have a very low interest rate, right? REIT Global in euro. Okay, from here, we more or less combining the financial ratio itself, we can do some risk assessment over here. Okay, and also I also track the property yield. Okay, debt maturity profile. Now, just now we talk about the interest rate. So which REIT has the highest probability to really to increase the dividend moving forward when the interest rate cut? So prime US REIT, okay, they have opportunity to do a refinancing at a lower rate. Okay, and also, okay, ECW already suspended. Okay, so for example, Daiwa House 1.7 years. Okay, but they are actually borrowed in Japanese yen. It may not benefit the Japanese yen, right? But mainly you'll be on the euro side. Okay, so that maturity profile, the current borrowing percentage on the and also secure unsecured borrowing. Okay, unsecured borrowing, basically I am looking into it. If the REIT is not able to finance the debt, or they are not able to pay for their interest obligation, whether the creditor has the right to possess their property or not. Because once they are able to possess the property, basically you lose the rental income from that property itself. At the same time, they may go to default, right? So the unsecured borrowing now is important. Last time, no. Okay, all right. Okay, then we also see that okay, for diversification purpose, we want REIT to have as many property as possible, right? Because if one property go into trouble, at least that you not affect your DPO payout, right? Like for example, if you look at the Sesio REIT, only got 4 property. If one of the more down, okay, that means that there were big impact. Land lease also same thing, only 5 property. Paragon REIT 5 property, and this is a total portfolio AUM. Okay, so this one give me a one glance to do a quick short listing to see which one I want to shortlist to invest, put in the watch list or not. We know that if you want to go through everything to shortlist is not easy. Okay, now the next thing here is, for example, some of the REIT, they are trading. We can see from here that whether they are trading the 5-year or 1 year price to book low. Okay, one glance, I know that, okay, Acrophik Hospitality Trust used to be ARA Hospitality Trust, actually trading at 5 year low. Okay, and from here, I also know that, okay, which REIT, okay, they are trading at a 5 year high in terms of price to book. So that this gives me some sense of whether it's a good time to really buy or not. Because based on the price to book itself, some of the REIT is forever trading at the very high price to book. For example, Keppel DC REIT is a data center REIT. The price to book at the present moment is 1.61. If you just pure based on the textbook style, textbook answer, actually Keppel DC is trading 60% premium to the fair value. Okay, but not necessarily trading 60% fair value is good, because if you compare to the historical price to book, they are still pretty attractive. Okay, same thing here, Parkway Life, trading at 1.56, 56% premium to the book value. But if you look at a 5 year trend, they are actually trading low to a 5 year trend. Okay, then this one just give me some indication. If you want to know in the detail itself, right, I'll click into the individual REIT to see what are their performance. Okay, so one glance, okay, I even know that who will be the sponsor and what is the percentage of the sponsor. Okay, so Parkway Holding have a 35.6% from sponsor own 35.6. We know that that's why some of the interest is aligned with the sponsor. And I also want to see whether that which index actually they are in, right? The reason being is because I don't, if some of the REIT is just sometimes big cap REIT, like you sell off for nothing, then I will come here to take a look whether is there any index removal or big institution actually getting out from an index or not. So the index percentage is important, right? And also from here, then I also have some insight where are all the locations. For example, for Parkway Life, 60, they have a 60 property in Japan, 3 property in Singapore, and also and some of them in Malaysia. Okay, and these are all the financial ratio. For example, price performance, lease management, total 63 property, 100% occupancy rate, will 15.8 years. Okay, AUM, fundamental analysis, fundamental ratio, yield, gearing, PNAV, those are the standard one. Debt management, under debt maturity, interest cost, ICR, fixed rate percentage, unsecured borrowing, and also I included the ESG rating here. Okay, because moving forward, what I want to try to do is I want to establish a correlation, right, to see that whether the share price or the valuation of a property itself, because we know that Parkway Life, they are trading at a premium, which parameter actually contribute can have a significant impact on the PNAV. Why are they trading at the premium? Okay, at the present moment, we just based on our gut feel, okay, because they are hospital. Right, that's why they have a hospital, they have a nursing home, that's why they're trading at a premium. Okay, or maybe it's caused by they have a very low interest cost because their risk is very low and very high interest cover, plus the very high lease expiry. So with all the parameter here, we can establish that what would be the fair PNAV or also a share price, right? That will be the next phase as I discussed with you, right? We can have all the data to really establish a correlation. Now, the next one will be the PNAV, right? So the question to the investor, they will ask, PNAV 1.57, overvalue. Textbook, 57 premium, overvalue, don't buy. Okay, so that they can never buy. But if you look at the historical value, right? At one time, the peak, Parkway Life can be traded plus 2 standard deviation from a historical average at 2.3 times. So now it's only 1.57 times. At the historical, it's 2.3 times, 2.5. Okay, now the value is only 1.56. Actually, it's traded close to -1 standard deviation below the average. Okay, if you look at this one, you know that actually at the present moment is a good time to enter. Right, it's undervalued based on historical value. Okay, and also this PNAV also supported by increasing in NAV because we don't want the NAV for the sum of the property keep coming down. Okay, because this one going up, this one coming down, which means that this is attractive. Okay, Then from here, I also have a dividend yield, the historical dividend yield, okay, where what's a high, what's a low, and yield spread, and the gearing ratio trend, okay, to see whether their gearing ratio, whether getting worse and worse or improving. And also more importantly is whether they are paying us a DPU year over year, and this DPU is growing year over year. This is what we should look at, bottom line, what we receive as an investor, right? Then here I will put in share price. Okay, share price will give you some indication. Okay, so I combining everything. First thing first, the share price come back to the support level. Okay, the next question is, when it come back to support level, is it a good time to enter based on the valuation, right? Based on DPO, definitely it's good because it's growing. Right now, because the share price come back to this level, more or less that if as long as this support is whole, that means this is the maybe probably we are seeing the low for Parkway, and I will see that whether net asset value growing, net asset value growing is healthy, now it's stabilizing, right? And also historically price PNAV, whether they are at the higher range or lower range, now is undervalued. So from here I can make a decision, okay, this is a good entry point for Parkway Line. All right, so this one is for individual REIT. Now if I want to do some comparison quickly, now the question is common question, capital REIT and digital core. Okay, do take note, it's not a recommendation. Which one is better to invest? Common question, right? I quickly can do a comparison. So I'll group everything, all the REIT which have a data center into the portfolio. So Mapletree Industrial Trust also have a data center. Ascenders also have a data center. And moving forward, Elite UK REIT will have a data center. So I just key in the 4 REIT and straight away I can have a comparison table come up. Capital DC REIT, Digital Core, Mapletree Industrial Trust, Capital Land, Ascender REIT. And what is a percentage of data center in your portfolio? 100% data center, 100% data center. The 54.7% data center for Mapletree Industrial Trust, and Ascenders only got 8% data center. All right. Then from here, I can immediately just eyeball, you know that actually which REIT is doing well. Right. You can see that actually, you look at it's an uptrend. Okay. And the yield comparison, okay, Capital DC 4%. Now Digital Core 6.1%. Definitely more attractive, right? And also the gearing all healthy. Price to book, if you are looking for price to book, Capital DC is very expensive, trading at a discount, and Digital Core at a discount. This one is a premium, this one at a discount, right? And all these things are at a premium. Okay, and number of property, and what is the will, and what are the comparison in terms of debt management. So one glance, I can make a decision over here for comparison purpose. Okay, so this one, I use this REIT Screener to really help me to speed up all my analysis, right? So because we have a lot more thing to do, right? And also we can spend more time to do the analysis, to look at macro, to look at fund flow instead of focusing on data crunching, because just too much data if you want to maintain our Excel spreadsheet. Crunching data are not really value added, basically. Right?
Yeah,
Right.
agree.
Yep.
Yeah. So I think this is a really awesome tool for those who keep asking whether I can buy this, I can buy that. I think with this tool, at one shot, you don't have to ask. You just need to just put in the REIT that you want to find out more about, and you have your answer right there within a matter of seconds.
Yeah.
Yeah, and I believe that this tool, despite having so many features, it does not cost an arm or a leg. Am I right?
Yeah, it's pretty cheap. I would say based on the effort we have put in, and also I want to continue to build this screener to be more powerful, and I want to integrate some of the artificial AI model in predicting a share price, because now we still need to eyeball ourselves, right, to see that actually which REIT based on all the all the financial ratio here. Okay, not all the financial ratio has a significant impact on the share price.
Correct.
Okay, only some of the financial ratio have some significant impact. Okay, now we can only eyeball, right? But moving forward, what I want to do is I want to put in all these kind of parameter, okay, which financial ratio or the qualitative analysis has the most significant in the share price so that we can focus on it. Okay, eyeballing by eyeballing, what I think that why the REIT can trade it as a high premium at the book value, just purely based on eyeballing. First thing is the percentage of data center. Okay, because if you compare to the commercial office, you compare to retail mall, data center definitely actually trading at a premium. If there's another data center come into the IPO itself, more or less we can do this comparison now. We can more or less can come out what would be the IPO PNAV. That mean is a fair value lah, right? That's first thing. Second thing is if you eyeball the data here, the sponsor play an important role. This sponsor is not really well known in Singapore. Okay, that's why you can see that they are trading at a discount. Okay, but whether my eyeballing stack is true, I do not know. That's why I need to build an AI model to really use the data, use statistics to really prove that this parameter, this financial ratio are a critical measurement. So in future, whenever there's any IPO coming in or when we want to analyze the overseas rate, immediately we know that what are the key ratio we should look at instead of just dealing with too much noises, right? Because we get so many financial ratio, we don't know which one is more significant.
Yes, I agree. But as it is right now, I think it's a fantastic tool for anybody who is interested in REITs and they do not have the time to browse through the quarterly reports as well as the business updates. So within a matter of seconds, you can have everything that you need in your fingertips and make your investment decisions based on that.
Yeah. And actually, I'm using this tool myself to advise my client. I'm charged a fee to give my financial advice and also advise my client how to build a REIT portfolio, right? I'm using this tool. So this tool is for practical usage and also for licensed financial advisor, right? It's built by the investor and also for investor and also for financial advisor like myself. So this is a practical tool.
Fantastic. Yeah, I think for those of you who are interested in Kenny's REITsavvy Screener, I will be putting the link down in the video description below, and you can have a look at it yourself. Yeah. So coming towards the end of today's really insightful presentation, if there's one key takeaway you would like the viewers to remember from this whole session, what would it be?
Okay, still come back to the objective. If we want to build our dividend portfolio, right, for 5 years, right, if you want to be financial independent or retirement, REIT is one of the asset class I think that everyone must have into our portfolio because at the end of the day, the business model is very easy to understand. It's the landlord business, right? So you can, because most of the Singaporean here, we like property. So REIT is the proxy to property investment and also is quite hassle-free. The only disadvantage is the price volatility. But if you don't really bother about the price volatility, you are focused only for dividend payout quarter over quarter, year over year, REIT is a good asset class. Just accumulate along the way when there is a price weakness. Actually, if you have not built out your total portfolio, any sell-off or any bear market in the REIT sector, you should be very happy. Right? So I think that that is my key takeaway. Just build along the way, continue accumulate until you reach your objective. Okay, my target is I want to build a 10,000 per month dividend portfolio for my REIT. Okay, at the present moment, I have not reached my goal yet. I am close to 8,000 per month now. So still got 2 more thousand to go. So once you set a goal, that's why you just look for opportunity to really buy consistently in the market when the market tell you that please buy me, because every now and then, based on the valuation, based on the technical analysis, there are opportunity here and there.
Correct. Definitely. I think it's also important for investors to invest in like how they go shopping on Shopee or Lazada, where you should buy when there's a big sale going on. Yeah. So coming to the end of the presentation, how can the viewers connect with you or learn more about your work?
Okay. There are many places to get me up. Okay. One of the place is you can add me in my LinkedIn, right? So basically, actually a lot of updated information here. Actually, I post on my LinkedIn first, right? So some of the article, because this is more on the, okay, you can see that some of the article have post on my LinkedIn, right? And also, for example, recently, okay, just show some example. I'm also joined one of the forum, Islamic forum in Singapore itself, right? That's why I may be also discussing with them to present what would be the Sharia REIT available in Singapore, right? Moving forward, okay? Because for REIT also there's a Sharia compliant REIT list. I have the whole Sharia compliant REIT list in Singapore for the Muslim investor, for Islamic investor. So I'll post some of the key takeaways here. What I understand from the forum, and also every month I'll post some other article over here, right? There are many articles over here, right? And for example, the weekly update on the REITsavvy itself, and this was the last visit to the CapitaLand Escort to Live Funan. You were there,
Yeah,
right? So I
correct.
post it. Yeah. And also I also post my course and also key takeaway from the AI and also analytic in business valuation. This is where I get the idea how I can build the AI model on the REIT sector. Okay, because there are a lot of regression analysis, there are a lot of tools available here. As long as we have a data and we know how to learn the tool, I can create the AI model for the REIT sector. So this is one of the things I want to do moving forward, right? And also I'll post my SGX Academy webinar over here, some of the key important webinar. And also sometime I have a joint seminar with some of the fund manager. So this fund manager is a private credit fund, another type of instrument which can give us 10% per annum dividend yield. 10%.
Wow.
REIT is only 5 to 8%, 10% and very, very consistent, right? So I have a chance to really meet with this CEO. I invite him as an invited speaker to share about the private credit as part of the portfolio diversification. Okay, and also I also explaining what is SRS all about, how the investor can use a SRS to do your tax saving, because every single cent you save, the saving you can invest in REIT to build a portfolio to generate dividend. Okay, so there are a lot of information here. You can join me in the LinkedIn, right? Then the other link for you to find me is you can Google me, engage Kenny Law, right? And this is the URL. So basically, as a financial advisor, these are the services I provide. I also have a lot of article over there. Okay, for example, okay, on a Channel News Asia, what is the difference between an ETF and mutual fund, and what are the 6 reasons why we should consider REIT in Singapore for our retirement, and what are the challenges, investment challenges, and also dilemma for financial professional in Singapore. And some of the webinar I also put it there. All right. For example, I also have a 理财 oh yeah in Mandarin 投资股票前需要做的几件事和风险管理的秘诀。Then after that, I was also have some article on the estate planning and some of the 3 common estate planning mistake in a personal investment. There are a lot of information here, right? If anyone want to follow me, my market upload on the MoneyFM, I have been on MoneyFM since March 2020 during the COVID crash until now. Without fail, every month I'll give the Singapore money update, right? So if you want to know what's happening in the Singapore sector, you want to have some insight, you can go there and listen. Many years already. Okay.
So it's once every month?
Once every month. Yes, once every month. All right. Okay. And sometimes Michelle Martin post me web challenging question without prompt me. That's why I have to react to a certain question without any preparation. Okay. Okay. So another thing is I have a Telegram channel to post all my update here beside my LinkedIn. So this is a Telegram channel QR code. I post some of the REIT news over there. Okay, because I normally when I do want to do research, I need to put all the information into one place. So I put all those analyst information or from Business Time, from the Straits Times, okay, and so that I can treat as my library when I want to do research, when I want to review, and also when I want to post my seminar webinar, I'll post it there. So anyone want to follow me and also want to know what our seminar or future webinar I'm conducting, you can join this Telegram group because I'll always post there first. Okay, and some of the exclusive interview with the REIT manager, I will also post there. Right. So
Wow.
this retirement Telegram channel mainly focus on the REIT itself, and also some, because it's retirement related, so some of the retirement topic I will also put there. All right. So these are the places you all can find me.
That's really a wealth of information that you have provided out there. So for those of you who like to connect with Kenny, I will be putting all the links down in the video description below. So it will make it easier for you to click and directly go to the respective sites. So with that, I really appreciate all the time that you have spent to share with us the insights about the REITs latest quarterly results, and also the really, really wonderful REITsavvy Screener, which can save investors a lot of time in doing researches where they can just put in the parameters, and then they can immediately know everything they need to know about REIT, including spotting red flags. And that is what I really like about this whole tool. And for those of you who are interested in these two, I will also be putting the link to it in the video description below. So you can have a look at it. And with that, I have come to the end of today's really insightful discussion. Thank you so much again for everything, Kenny. I really, really appreciate it from the bottom of my heart. And for those of you who find this video useful, I would greatly appreciate it if you can give this video a like. And I hope for those of you who have been watching it from start to finish, you will find this video very useful, because for me personally, I really learned a lot from you in this 1 hour session. And thank you so much once again, Kenny, for everything. Yeah. And yeah, and for those of you who have any questions for Kenny, you can reach out to him on her links below. And I'm sure, yeah, you can get a response from him. Yeah. So with that, I'd like to thank you once again for watching, and I hope to talk to you again sometime really soon. Yeah.
Okay. Thank you. Okay. Bye-bye.
Thank you so much. Bye-bye.